Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be doing a full revision for Ind AS 102 share-based payment with all the important questions and almost certain 6 to 8 marks weightage in your exam, and hence this is something which is fairly important. So let us get started. Now, share-based payment, a classic example of share-based payment would be something like an ESOP. Now, ESOP involves payment to the employees for their services. Usually in ESOP, the payment goes in the form of shares of the company. Generally, the purpose of this is to keep the employees motivated and feel that they consider themselves to be a part of the company, and hence salaries, wages, gratuity which is paid to the employees in the form of cash would be covered under Ind AS 19. However, if ESOPs are given to the employees, they would be covered under Ind AS 102 share-based payment. Now, the heading of the standard is share-based payment and not necessarily payment in shares, and hence if there is any payment to, let us say, employees for example, in the form of cash, that would also be covered under the standard provided it is considered to be share-based. So when we look at the share-based payments, it can be ESOPs or it can also be something like a stock appreciation right, also called as a SAR. So what happens in case of a SAR? Let us say you give an option to the employee with an exercise price of 50 rupees and you give the choice to the employee to exercise. So if the employee exercises it, you are responsible for giving one share, the employee will give you 50 rupees. Now, instead of the employee giving you 50 rupees, you giving a share, we say that at the end of the day, we will give you the cash which is equivalent to appreciation. So for example, on the date when the employee exercises the option, the market value of the share is, let's say, 110 rupees. Then rather than employee giving me 50 rupees, I giving them one share whose value in the market is worth 110, I'll give them net cash worth 60 rupees. This is called as share appreciation rights, also called as cash settled plan. ESOP on the other hand is called as an equity settled plan. So when we are looking at SARs, they settle in cash. However, the payment is based on the shares, and as a result over here even SAR is covered under Ind AS 102. Now we now know that Ind AS 102 covers employee based share based payment in the form of ESOPs or even SARs, but it also covers share based payments to other than employees. Like for example, I might want to purchase a building but I don't have money, so I'm going to issue my own shares. So even over here, this is a share based payment for goods. The standard does not read as share based payments for employees. It says share based payments, which means even if it is for other than employees, like for purchasing goods or for paying for maintenance services, that will even be covered under the wider scope of Ind AS 102. So that kind of gives you a broad understanding of the scope of Ind AS 102, which will include the share-based payments, can be equity settled like ESOP or can be cash settled like a SAR to employees or even other than employees. Now, a few key terms for this topic before we go into the accounting. One is there is something called as a grant date. Grant date is a date in case of employee share-based payments, is a date when the plan is finalized, communicated, all the necessary approvals have been received. That is the grant date. It is an important assessment because when you do the fair valuation for employee share-based payment plans, it does happen on the grant date. On the other hand, if it is for other than employees, the grant date is a date when the contract is agreed into. So for example, I might agree into a contract on 1st January to purchase a building, let us say on 30th June, in which is a grant date, is a date when contract is entered, that is on 1st of January. However, for other than employee share-based payment, the fair valuation is usually done when the goods are purchased. So the risk and reward are let us say transferred, let us say 30th June. So there is a slight difference in the grant date and the fair value measurement date for employees and other than employees, which we will discuss further as well. Second is vesting period. Vesting literally means entitlement, and vesting period means the period that needs to be served, let us say, by the employees in order to be entitled to the options. So when we look at the vesting period, let us say as 3 years, that means the employee needs to render service for a period of 3 years for the employee to be entitled for the option. If the employee leaves any time before 3 years, they will not be entitled to any options. Second, you have something called as exercise period. Usually exercise period starts after the vesting period, and as a result, this is a period where the employee, if they want to, can exercise the option. Now, is it compulsory for the employee to exercise? No. So if at the end of the exercise period they don't exercise it, the options will kind of lapse. However, if they do exercise it, we will be required to issue shares in case of ESOPs or pay for cash in case of SAR. Now, exercise period, the employee can leave the company if the employee wants. Now, when we record employee benefit expenses, we typically spread this over the vesting period, because in the exercise period, the employee is free to leave the company if the employee desires. So largely, the benefit is attributable to the service rendered during the vesting period. Next, there are two very important terms: fair value and intrinsic value. Now, Ind AS 102 necessarily requires that employee share-based payments would be measured based on the fair value in general for ESOPs at the grant date, and as you will study further, for SARs at the fair value at each balance sheet date. Now, why is that? And why is it fair value? There is another term called as intrinsic value. Now, what does intrinsic value mean? Intrinsic value quite literally means the market price of the share as on date minus the exercise price. So let us say the options are granted on 1st April 24 with a vesting period of 3 years, that is they vest on 31st March 27. If on 1st April 2024, that is on the grant date, the market price of the share is 80 rupees and the exercise price is, let us say, 50 rupees, the intrinsic value on 1st April 24 will be 30. 80 minus 50, that is equal to 30. However, Ind AS 102 says that to measure the benefit for the employee based on the value on 1st April 24 is wrong, because the employee will not be getting the benefits on 1st April 24. He will get it on 31st March 27. So if this is a company which is growing, the value on 31st March 27 in all likelihood will be much higher. If the company is on a declining trajectory, the value on 31st March 27 might possibly be lower. So the appropriate measurement of the benefits is when the employees can possibly exercise it, and as a result, you will try to find, using various valuation techniques like you will do in your AFM, the binomial model, Black-Scholes model, etc., based on the expected share prices that can possibly happen, you will find the fair value of the option. Fair value will typically and almost always be given to you in the question, but for your conceptual understanding, this fair value would be calculated using option valuation techniques like you do for binomial, Black-Scholes, etc., in your AFM valuation. So when you try to find the employee benefit expenses in case of an ESOP or a SAR, you will take it based on the fair value. Remember, intrinsic value you will know on the grant date, but that is useless because at the end of the day, employees cannot exercise the options on the grant date, and hence we will try to use some prediction methods and try to find the value after a few years when the options can realistically be exercised, and based on that do the option valuation. So fair valuation is a must, and ESOPs or SARs will be accounted using the fair value which is prevalent for these options as on the grant date. At least for ESOPs. For SARs you will take it at each balance sheet date. We will see the reason why. Okay, so is the intrinsic value relevant? In general, no. The only place where intrinsic value becomes relevant is in case of SARs, when the SARs get exercised. So usually an employee, when he or she exercises the option, he will not look at what the ledger balance in the company is. They will not look at what the fair value, what you thought was. When if they exercise, for example, on 1st April 27, they will look at the market price on 1st April 27, they will compare it with the exercise price, and then the difference between the two is the actual appreciation that you will have to pay. So this is the intrinsic value on the exercise date. So when you have to pay to the employees, you will pay to the employees based on the intrinsic value as on the exercise date. So just remember, in case of SARs, when the payment happens, you will pay based on the intrinsic value as on the exercise date. But for accounting, you will have to do accounting during the vesting period. We don't know what the actual value would be at the time of exercise during the vesting period, and hence our working will be based on the fair value. So these are two terms that you need to be quite clearly aware of. Next is employee share based payment. How will you record it? The timing as well as the measurement. Timing, in case of options having a vesting period, let us say 3 years, you will spread it over the vesting period on a straight line basis, not on any other basis, or over the straight line basis. However, there may be certain questions where options immediately vest. This can be for ESOP, this can also be SAR. If the options immediately vest, this may be because of compensation for past service rendered, and as a result, there is no future service mandatorily required because of these options, and hence the standard says that if these options are immediately vested, then the entire fair value should be recorded as EBE as on the grant date only. There is no need to spread it over any further period. How will you measure? Well, the standard believes that, let us say, at least in case of employees, and vast majority of the questions do come for employees. In case of employees, when you look at, let us say, these transactions, it is more like a barter. Like the employee renders service, and in return of that service, like they get salary, wages, pension, provident fund, etc., they get share based payments, they get the options, they get shares of the company. So it is like a barter, and barter is usually measured at fair value. But which fair value? Is it the fair value of employee service or fair value of the options? Ind AS 102 necessarily tells you that the measurement will be based on the fair value of the options only. So fair value of employee service, if any, is irrelevant for Ind AS 102 measurement. Okay, so now you go to the accounting part. How will you pass the journal entries? Well, during the vesting period, let us say if you look at a case where a company has 10 employees, to every employee they have given, let us say, one option for simplicity, and the fair value of each option is 30 rupees. So 10 employees into one option per employee into 30 rupees. So that comes to maybe 300. So this is the total benefit that I'm granting to my 10 employees. Will I record this 300 rupees immediately on the grant date? Answer is no. You will spread it over the vesting period. Let us say the vesting period is 3 years, then you will spread it over the vesting period on a pro rata basis. Let's say 300 into 1 by 3, that is approximately 100 each year. Now what will be the entry for this 100? Something account debit. Well, what will you debit? Well, it is a barter, and in this barter the employee is rendering service for which after 3 years you have to give, let's say, options or shares, and hence employee benefit expense will be debited, which will go to the P&L. Like in the employee benefit expense, you have various items, like you have let us say your salaries, wages, pension. You will have another line item, that is share based payment cost. So you will have employee benefit expense account debit, that will go to the profit and loss account. And what will you credit? Well, typically we will credit what is called as stock options outstanding, because these are options which are outstanding. Now Institute, instead of calling these as stock option outstanding, uses a different word called as share based payment or SBP reserve, as the case may be. Now how will this SBP reserve appear? It is very important to note that this SBP reserve will appear as a part of other equity in my balance sheet. This will not be appearing as a part of liability. It's a very common mistake that the student makes is, well, this is outstanding, so it is a liability, but still it is going to be settled in entity's own equity shares. If it is going to be settled in own equity shares, what is the point of showing it as a liability? And hence we will show it as equity. Generally it settles in fixed number of entities own equity shares, and hence we will show this as equity. There is no liability. It should not affect our debt to equity ratio, for example, and as a result SBP reserve will be shown as a part of equity. And a very important point for you to know is, you do not remeasure own equity shares. Like for example, DMart might issue shares in an IPO. Now after IPO the shares of DMart might change, but the market price might change. But if you look at the balance sheet of DMart will not remeasure its own equity share capital. It will remeasure assets and liabilities, but not its own equity share capital. And as a result, own equity as per GAAP is not remeasured, and SBP reserve, which is a part of other equity, will also not be remeasured. So your entry will be EB account debit to SBP reserve, and then EB being a nominal account will be transferred to the P&L. You will put these entries in each of the years. Another interesting adjustment that can arise over here is, what if the entity expects a few employees to leave? There are 10 employees, but we do expect that one employee will leave each year. As a matter of fact, one employee has left in the first year, so you are left with 9 employees, but then you are expecting another 2 employees to leave over the next 2 years. Standard says you will measure the EB based on the expected employees which are expected to continue till the end of vesting. That is 7 employees. Sir, but actually there are 9. But we don't expect these 9 employees to continue, and hence you will measure the expense based on the employees who are expected to continue. So basically there will be 7 employees into one option per employee into rupees 30, that is a fair value on the grant date, that is 210, prorated 70, 70, 70 approximately in each year. Now is it possible that the estimate of the number of employees can possibly change? Of course. If the estimate changes, then you will take the estimated number of employees who are expected based on the most latest estimate. So if in the second year you expect that one employee has actually left, in the second year no one left, but now you expect in the third year one more employee will leave, and hence you will take probably 8 employees who are expected to continue and do the working. The working over here will be, you will usually take 8 into 1 into 30, that is 240, into 2 by 3, that will give you probably, I think, 160 to be recorded till date, out of which 70 was earlier recorded, and hence 90 will be recorded in the second year, and so on. You will keep on doing for each year. In the third year you will actually know the number of employees, and hence the working will be based on the actual number of employees that the entity has. Now this brings you to the end of the vesting period. Now during the exercise period there are 2 possibilities. Now during the exercise period the options may be exercised. This is an ESOP. In the case of ESOP, you will debit the bank with the exercise price. Let us say 50 rupees is our exercise price, bank account debit 50 to, well, typically equity share capital, because you are going to issue shares. So let's say at face value 10 rupees. But is there anything else that is to be debited? The answer is yes. You will try to debit the SBP reserve. Why will we debit the SBP reserve? Well, because you are issuing shares because the options are exercised, and as a result you will try to say that the true issue price of these shares is not just 50 is paid in cash, but other than that another 30 is paid by the employee through service, and as a result bank account debit 50, SBP reserve account debit 30, to share capital 10, to securities premium for example 70. So this will be on exercise, shares being issued. If the employees don't exercise, then by the end of the vesting period, end of the exercise period, the options lapse, and hence you will have to reverse the SBP reserve. The entry is SBP reserve account debit to, let us say, retained earnings. This is on lapsing of the options. Why retained earnings or general reserve? Because it is like an owner to owner transaction. Like for example, when you do admission or retirement of partner, when one partner retires and we believe that you had to pay him 30 rupees, the partner says, I don't want anything. In which case you debit the retiring partner and credit the continuing partners. You don't show this as profit of the partnership firm. You say, okay, C capital account debit to A capital to B capital. Here, the continuing partners are like equity shareholders, and hence you credit the retained earnings, but you can't credit a profit, or you can't credit this as profit for the year impacting the net profit. You can let something affect the net profit if it is a transaction between outsiders. If it is a transaction between owners, like dividend paid does not go in finance cost, it goes directly in retained earnings, but interest paid, which is paid to the outsider, goes as a part of finance cost. In a similar way, lapsing over here will be going through the retained earnings. Now this is the case of an ESOP, and in case of ESOP you have to remember that you will take the fair value as on the grant date only. Usually the institute does not even give you the fair value at each balance sheet date, but even if it is given, like in one of the questions it is, you will resist the temptation and you will take the fair value on the grant date only. The logic being that own equity cannot be remeasured, and hence you will continue to show it at the fair value as on the grant date. But when you look at a SAR, the SAR is not going to be settled in own equity shares for a fixed number of entity shares. In fact, the SAR is going to be settled by payment of cash, and hence even SAR is an employee benefit. So when you do the working for SAR, you will still take the number of employees expected to remain till the end of vesting, let us say 7 employees at the end of the first year, into 1 SAR per employee, into you will take the fair value at each balance sheet date, not on the grant date. Why? Because you have an obligation to deliver cash. That is a liability, and you remeasure assets and liabilities. You don't remeasure own equity, but you do remeasure assets and liabilities, and hence SAR will be shown at the fair value, and hence you will show, let us say, an SBP or share based payment liability on account of the SAR. So that will be an SBP liability being created for the SAR. After that, at each balance sheet date, as the value of the liability changes, you will keep on remeasuring it. The working will be the same. You will try to find, for example, if the fair value at the end of the first year is, let's say, 45, you will say 7 employees into 1 option per employee into 45, that is 315. 315 to be spread over the 3 years divided by 3 will come to, let's say, 105 in the first year. Second year, maybe the fair value changes up to 60. The number of employees expected to continue is, let us say 8. Then you will keep on doing the same working. Your entry over here will be employee benefit expense account debit to, usually we can show this as provision for SAR, but institute over here calls this as an SBP liability, share based payment liability, which will be shown within the current or non-current liabilities as a case, maybe not as a part of other equity, and hence you can remeasure this at each balance sheet date. Now at the time of exercise, when the SAR is, let us say, exercised, let us say investing period, EB account debit to SBP liability, and EB gets transferred to the PNL. During the vesting period, when the SAR is exercised, at the time of exercise, your journal entry would be, well, SBP liability account debit to bank. There is no further bank account debit, share capital credit. No, it is not an ESOP case, it is a SAR. And in case of SAR, the employee does not have to pay me 50. I don't have to give shares to the employee. In fact, I just have to pay the appreciation. So my entry will be SBP liability account debit to bank. Now, this payment entry, one needs to remember, is going to happen at intrinsic value, because the employees don't know what the fair value is. They don't even need to know. They don't need to see what is there in the ledger balance. The employees are going to just do a simple mathematical calculation of comparing the market price on the date when they exercise with the exercise price. So if that comes to, for example, 75, I have to pay 75. But what if in my ledger I've recorded an SBP liability of 60 only? Typically, if the vesting happens on 31st March 27, exercise also happens on 31st March 27, then usually the values would be the same. But it is very much possible that if the exercise period is 1 or 2 years, and then you decide to exercise, for example, on 30th September, in your balance sheet, at the last balance sheet date, you have shown this SBP liability, let us say, at 60. But when you go to pay, there has been further appreciation, you end up paying 75. In which case, SBP liability account debit in your ledger, only 60 is appearing per option. To bank, you'll have to pay 75. And hence there will be a balancing figure of 15 rupees. Where will this 15 go? Well, also to EB. Why? Because this is an additional payment done to the employees, and hence that will also go as a part of EB. In fact, it is very much possible that it can also go the other way around. SBP liability in your ledger is 60. You end up settling that at, for example, 56. So to bank 56, in which case 4 rupees will be shown as reversal of EB. Are we clear with this? So this is regarding SBP liability paid. Is it possible that there are certain options? Exercise period is 2 years. So you had, for example, 6 employees who continue till the end of vesting, out of which 4 of them exercise the options in the first year, but the 2 of them did not exercise in the first year, but there's also 1 more year of vesting of exercise period, in which case is it possible that as on the end of the 4th year, so 3 years vesting plus 1 year exercise, so at the end of the 4th year there are still certain employees whose options are not yet exercised but they have not even lapsed, in which case what will we do? Well, we will still have to remeasure. Why? Because as per Ind AS 37 for example, and generally accepted accounting practices, liabilities should be based on the best estimate of the amount that you expect to pay. So till 31st March 27, we expected that we'll have to pay probably 60 rupees. However, later we now expect that we'll have to pay probably 75 or 90 rupees, in which case you will have to remeasure the SBP liability. Do you need to do this for ESOP, SBP reserve? Answer is no. You do not even remeasure the SBP reserve during the vesting period. You don't even remeasure it during the exercise period. But in case of SBP liability, you remeasure it at each balance sheet date during the vesting period, and also for the unexercised options, you remeasure it at each balance sheet date at the fair value, even as on the subsequent period. So ensure you do that. For example, if the fair value comes to, let us say 90, it can be 75 as well, let us say 90, in which case I will say in my ledger the SBP liability was at 60 per option. Now that SBP liability has gone up to 90 and hence SBP liability needs to be credited by 30. If SBP liability is credited, what is debited? Well, EB, employee benefit expense, will be debited, let us say, to the profit and loss account, and hence EB would be debited, it goes to the P&L of 30 rupees. Okay, so EB account debit, let us say, to SBP liability, let us say 30 rupees. Now in the next year, if these 2 employees exercise the option, and when they exercise, let us say the appreciation is even more, you have to pay 110, then SBP liability account debit 90 to bank 110, and the balancing figure of 20 will go to EB. However, if these employees do not exercise it and the options lapse, then SBP liability will be debited. But what will you credit? Well, we will credit P&L, not necessarily retained earnings, P&L, because it is a transaction with outsiders, not an owner to owner transaction. So these are the few important points. One needs to remember that you need to reassess the SBP liability at each balance sheet date during the vesting period and even after the vesting period during the exercise period, based on the fair value at each balance sheet date and based on the number of options that are expected to be exercised ultimately at each balance sheet date. Okay, next you have share-based payments other than employees. So when you look at share-based payments other than employees, you will have 2 things. Let us say, what is the timing when you record? Well, for goods, you will record the transaction when the risk and reward incidental to goods is transferred. On the other hand, for services, as and when the services are rendered. However, when we look at the measurement principles over here are slightly different. When you look at employee share-based payment, you said, well, we don't look at the fair value of employee service. We directly take the fair value of options or shares. Here it is the other way around. You give the first preference to the fair value of the goods received or the fair value of services received. If that is not available or not determinable, that is when, as a second preference, you will go to the fair value of shares or options issued. Now this is different, and a special case can arise in case of barter, Ind AS 16 versus Ind AS 102. When you do Ind AS 16 barter, usually we are told that the first preference would be the fair value of the assets given up. If not, fair value of the assets received, and if not, WDV of the assets given up under Ind AS 16. Typically, in case of a barter that you studied in Ind AS 16, you receive, let us say, a building, and you give up, let's say, a machinery, a land, software, something like that. You don't usually give up own shares. But if you end up giving up own shares, then Ind AS 16 ke samne specific overrides general, Ind AS 102 applies, and as per Ind AS 102, you will record this asset at the fair value of the building received as per Ind AS 102. So we have clarified this over here, that when your barter involves own equity shares, you will ensure that you will measure the asset received at the fair value of the asset received as per Ind AS 102 principles, because it is a specific provision, overrides the general provisions. However, if the fair value of the building received is not available, not determinable, that is when you will take the fair value of shares or options issued. While determining the fair value for other than employee cases, you will take the fair value as on the measurement date, that is a date when the risk and reward of the goods are actually transferred. The grant date may be a different date, that is the date when the contract is entered into, but the fair value is measured at the measurement date, which is the date when the risk and reward of the goods are transferred. You can get an MCQ over here, and you need to be mindful that in case of employees, the grant date equals to the measurement date is the date when all conditions are fulfilled, plan is approved, etc. But in case of other than employees, the grant date and measurement date for fair value are different for other than employees. Okay, so this takes care of the general discussion when we do for basic SAR and ESOP workings. Next we go to group share based payments. Now this is a special case. We'll go to around 4 or 5 special cases. Group share based payment, then we will go to vesting conditions, performance linked, market, non-market linked. Then we go to modification of options, cancellation of options, and maybe graded vesting. So let's go one by one for each of them. First is group share based payment plan. Now in this case, the parent may issue shares in the SBP plan of the subsidiary. Like Reliance Industries, a listed company, can be a parent. Its subsidiary Reliance Jio has a plan to do staff welfare, but Jio is unlisted. So its employees are saying that if I get 1 or 10 shares, where will I go and sell them? And hence Reliance says, well, you know what, rather than giving Jio shares, I will give my own shares because it's part of the same group. So parent is issuing its shares in the share based payment plan of the subsidiary, or it can also be the other way around. Like as we speak, at least Tata Sons is unlisted. There were news that it might get listed, but let us say Tata Sons as we speak is unlisted, and then there are subsidiaries like Tata, let us say Chemicals, Tata Steel, etc., which are listed. Now you want to motivate the employees of Tata Sons, maybe the subsidiary who has listed shares can issue shares to the employees of the parent. So there can be two possibilities, and in practice it's a very, very common thing. So how will the accounting happen? In the SFS of the parent, in the SFS of the subsidiary. So if parent is issuing shares in the SBP plan of the subsidiary, in the books of the parent, in the SFS of the parent, usually my entry should be EB account debit to SBP reserve. But I can't debit the EB because the employees are not parent's employees. So in RIL, hypothetically, if it was a pure holding company, it has no such employees. The employees are subsidiaries employees. So I can't debit the EB because they are not my employees. They are employees of another company. Okay, I can't debit the EBs. Then what will I debit? Well, people will say, let us say I will debit the subsidiary. If you debit the subsidiary, you are telling the reader that I owe, or I am saying that money is receivable from the subsidiary. In general, money is not receivable from the subsidiary, and hence you can't even debit the subsidiary. Then what will you debit? Well, that's a question mark. But what will be credited? Well, stock options outstanding or share based payment reserve. If you are going to issue shares in the future, you are going to issue your own shares, and hence your SBP reserve will be credited. So that is clear. But then what is debited? Well, the standard says that this should be treated as investment in subsidiary. This is treated as investment. Yes, we are not going to issue any actual physical shares, but this is like an indirect investment for all practical purposes. Let us say subsidiary does not have money. It wants to pay it to its employees. Where will it arrange the money? It will go crying to the parent. It will ask some money on a permanent basis from the parent, in which case the parent will do an investment in the subsidiary, and subsidiary will use that money to pay to its employees. Now, rather than the subsidiary taking investment from the parent, using that money to pay to the employees of the subsidiary, the parent is directly paying the money to the employees of the subsidiary and thereby indirectly investing in the subsidiary. So this is treated as an indirect investment. Similarly, in the books of the subsidiary, the SFS of the subsidiary, EB will be debited because the employees of the subsidiary are rendering service for which they are getting the benefits. So staff welfare is happening. So EB will be debited. But what will you credit? Well, you can't credit the SBP reserve because you are not going to issue shares of the subsidiary. You can't even credit P, that is a parent, because you don't owe money to the parent. Then what will I credit? Well, I will credit something called as a capital contribution from the parent, which is a separate line item which will be shown under other equity section. Capital contribution from the parent as a part of other equity. Now, when I prepare consolidated financial statements, investment in subsidiary and capital contribution from the parent will internally knock off, eliminate against each other, and hence in my final CFS there will be an EB and there will also be an SBP reserve. If it is the other way around, where subsidiary is issuing shares in the share based payment plan of the parent, in which case in the books of the parent employee welfare is happening, so EB gets debited, but I can't credit SBP reserve because parent is not going to issue any shares. However, I can't even credit the subsidiary because I don't owe money to the subsidiary. So what will I credit is a question mark. Similar in the books of the subsidiary, I can't debit the EB. I can't even debit the parent because money is not receivable, but I will credit the SBP reserve because shares are going to be issued. So what will I debit is a question. Now usually standard says, the general accounting practices say that when subsidiary needs money, it takes a permanent investment from the parent. But when parent needs money, it calls a subsidiary and tells it to distribute dividend. Subsidiary usually does not invest in the parent, rather it gives a return on investment that the parent has made, and hence it gives what we say is a distribution, or in company's law language, dividend. If you don't want to use the word dividend, that's fine, you can use the word distribution. So the standard over here thinks that in essence, if parent had to pay its employees, it did not have money, it will go to its subsidiary, tell it to pay the dividend, subsidiary will pay the dividend, parent will receive the dividend, and that money will be used to pay off the employees of the parent. Now, rather than calling for a dividend, receiving the money, paying that to the employees, we are telling the subsidiary directly to pay money to our employees and in a way indirectly distribute. So whether this is called as distribution or dividend as per Companies Act or as per Income Tax Act is a debate to be done as per that respective laws. In the books of accounts as per Ind AS, this will definitely be shown as a distribution. Whether it is going to be taxed as per Income Tax Act or not is a separate discussion. As per Income Tax Act, it will have no connection with Ind AS. So what we will show this in the books of the subsidiary, this is like a distribution given. So distribution will be debited, let us say, to retained earnings, and in the books of the parent, this is a distribution received, like a income in the books of the parent. So this is your entry. Even when we prepare CFS over here, the dividend distribution and the dividend income will be offsetted against each other, and hence EB will ultimately be debited. Usually something like SBP reserve or even non-controlling interest, if you understand it well, would be credited because this will be shares of the subsidiary that are ultimately going to be issued. Okay, that is one. Okay, another special case which I kind of skipped when I was discussing earlier is a very important one, that is cash plans with equity settlement alternative. Now this is a very interesting plan where you tell your employees that you work with me, let us say, for 3 years, and at the end of 3 years I will give you a choice on whether you want to take, let us say, 2000 shares with restrictions, maybe some lock-in etc. is there, or maybe cash equivalent to 1500 shares, let us say. So you have two choices. You serve 3 years with me. After 3 years, if you continue, usually in a pure ESOP, there will only be 2000 shares that are going to be issued. In a pure SAR, you will give cash which is equal to the appreciation in 1500 shares. But here, I am giving you the choice that you can do either of these. Can we say this is much more beneficial to the employee as compared to a pure ESOP or a pure SAR? Well, for an employee, if he has 3 offers, one is an offer from a company which is going to give them 2000 equity shares after 3 years, one is an offer from a company which is going to give them 1500 cash equivalent to the share price after 3 years, and one is a company which is giving a choice of either of these two. Assuming all the 3 companies and every performance etc. is the same, generally we will prefer the third offer as an employee because we believe that is a maximum compensation we are getting. So how will you account for this? Will you account for this as a pure ESOP or a pure SAR? Well, typically that depends on what fundamentally we would say what the employee will do after 3 years. But we have to do the accounting over the 3 years. We don't know what the employee is ultimately going to do. And as a result, the standard over here, like you do for convertible instruments and financial instruments, standard over here says that, well, you know what? Do we have an obligation to deliver cash? Yes. If the employee demands, we do have an obligation to deliver cash, and hence this will be treated as a pure SAR. But if you treat it just as a pure SAR, you will take the fair value at each balance sheet date and you will record the EB, which is perfect because the fair value, if it increases, that is reflected in your books. In a pure ESOP, that would not have been reflected. But is it similar to the pure SAR compensation? No. Along with the pure SAR, you are also giving an equity option, an option to convert into equity shares if you want. And that option can possibly have a value. So how will you find that value? Like in compound financial instruments, we do that liability component, equity component. Working in a similar way, how will you find the value? The standard says on the grant date. On the grant date, you will try to find the fair value if an employee exercises the equity option. So let us say if he exercises the equity option, there are 2000 shares he will get, and let us say the fair value of these shares as on the grant date, fair value, let us say, is 70 rupees. So 2000 into 70, for example, will come to 1,40,000. These are shares with restrictions. There is certain lock-in, for example. Now, alternatively, an employee can decide to even exercise SAR, one of the two, not both of them. If he exercises the SAR, he will get cash equivalent to 1500 shares, but these are shares without restrictions. You are going to get the cash. Let us say the price over here is 80. So 1500 into 80 is going to come to 1,20,000. So as on the grant date, if I treat this as a pure SAR, employee welfare worth 1,20,000 is going to happen, let us say, over 3 years. But if I treat it as a pure ESOP, employee welfare worth 1,40,000 is happening. So the fair value, if I treat this as a pure SAR, will be 1,20,000. But additionally, there is an equity option. Now, what is the value of the option? The additional 20,000. It's not 1,40,000. Otherwise, you will say 1,20,000 plus 1,40,000. No, you don't have both of them. You have only one, which the standard says has to be treated as a pure SAR. But this is a SAR with an equity option. And the value of the option is 1,40,000 minus 1,20,000. That is 20,000 per employee. And then you will take based on the number of employees expected to remain till the end of vesting. Remember, SAR will be remeasured at the fair value at each balance sheet date. But ESOP, or in this case the equity option may settle by issuing fixed number of entities own equity instruments, and hence it is in the nature of equity and own equity is not remeasured. So that 20,000 will continue to remain the same over the 3-year period. So now what will happen is, on the grant date, the first step is you will have to first find the fair value of the equity option, which is found by taking the fair value of all ESOPs minus fair value of all SARs as on the grant date. That will give you the equity option fair value, which is not remeasured. Subsequently, during the vesting period, you will try to find the fair value at each balance sheet date and try to record EB and corresponding credit to the SBP liability. At the same time, you will also record an additional compensation expense of EB account debit to SBP reserve for the 20,000, again prorated. This will happen during the vesting period. Now, during the exercise period, there are two possibilities. Alternative 1, the employee exercises the cash option. If they exercise the cash option, the entry will be SBP liability account debit to bank. And if there is any difference because of the intrinsic value being different, the balancing figure will go to EB. Now, you already created SBP liability and that is getting discharged. So, SBP liability account debit to bank. But there is also some SBP reserve. Now, that is lapsed because that is option which was given, which was not exercised, and as a result, SBP reserve account debit to retained earnings. It is an owner to owner transaction. SBP reserve is a part of other equity and now it is not exercised, so it will be credited to the retained earnings. But what if the employee exercises the equity option? Now, in this case, there are two alternative treatments possible. Earlier, the institute had only one treatment. Now, in the revised study material of May 24 as well as the suggested answers of I think May 23 or so, they have given you, or November 22, they have given you two alternatives. So either of them work. So one is, you are saying that, well, you know what, shares are being issued. What is the compensation consideration for the shares? The liability foregone. Remember, ideally I am treating this as a pure SAR. Ideally I had to pay cash, but because equity option is exercised, I don't have to pay cash, and hence the consideration for the shares issued is the liability foregone, and hence SBP liability account debit to share capital to securities premium. That has to be the entry. But what will you do with the SBP reserve? Now, as per the language of Ind AS 102, you will transfer it from one component of equity, that is SBP reserve, to another component. Now, that other component can be retained earnings, that other component can be, let us say, securities premium. So, Institute now gives you both the alternatives. In my opinion, taking it to securities premium is much more logical. So, your entry would ideally be SBP liability account debit, SBP reserve account debit, to share capital to securities premium. Alternatively, you can pass the entry SBP liability account debit to share capital to securities premium, and then the balance in the SBP reserve you separately transfer it to retained earnings. Institute study mat gives you both the possible alternatives. Okay, so that is regarding your ESOP with cash alternatives. Next, we have scope. What is covered over here? Well, all share-based payments to employees other than employees in shares or based on shares will be covered. So what is not covered? Three specific things. First is payment in shares or based on shares to shareholders in their capacity as shareholders, like right shares or bonus shares, will not be covered over here. Because the employees usually don't give any, the shareholders don't usually give any service in lieu of that, and hence you don't need to apply this 102 guidance. Secondly, if you are issuing shares in lieu of acquisition of control over a business, Ind AS 103 business combination, this is in the form of purchase consideration. For PC, Ind AS 103 prescribes specific accounting treatment, and hence the treatment as per 103 will generally be followed for PC. And third is the buying or selling or non-financial assets which can be net settled. Like you will study this in Ind AS 109. There are certain financial instruments which can be for non-financial instrument items you will net settle, like you sometimes do those commodity derivatives type of cases, that will also not be covered under Ind AS 102. So these are the three things which will not be covered. Now you go to the next part, which is vesting conditions. Now vesting is entitlement, and in general most of the things that you study is pure service based vesting. That is, you work in the company for the vesting period, that is 3 years, irrespective of how well or how inefficient you are. If you serve 3 years, you are entitled. So that is the service condition. You give service and you get entitlement. However, it is very much possible that in today's environment, merely staying in the company and giving service is not enough. You need to even perform. So there are certain performance based conditions which may also be attached. They may be linked to you working and trying to achieve a level of sales, profits, cost of production, market price, etc. So the standard over here says that performance conditions can be of two types. They are linked to performance. So vesting or entitlement linked or is also linked to you achieving a certain performance target. Now that performance can be market linked, that performance can be non-market linked. So when you are looking at a market linked, that means one of the conditions for vesting is linked to the market price or market price growth. So you just single out the company's market price or market price growth, and non-performance linked conditions would mean any factor other than market price. Can be sales, can be the attrition rate, can be the cost of production, can be the EPS, can be the profit, can be anything, but not the market price or market price growth related. Now, why are they singling it out? We'll see that the treatment is slightly different, because when you look at market linked performance conditions, the accounting is slightly different, the non-market linked is slightly different. So that is why when you read a question, you need to figure out whether if there is a service condition along with performance, and if there is a performance condition, is it market linked or non-market linked, because the working will be different. The non-market linked performance conditions accounting is fairly logical. Market linked to some extent might appear to be a little illogical, and it has to be done in a particular framework. We'll try to briefly understand why. Now, there can also be some non-vesting conditions like a waiting period. You have a vesting period of 2 years. Then ideally exercise period should start, but before that a waiting period is given of 1 year, and then exercise period starts. Now during the waiting period you can't exercise, but you can leave the company. You are still entitled to the options. So this is called as a non-vesting condition. In case of a non-vesting condition, you will not spread this over the non-vesting condition time period. Another example over here can also be non-compete. So sometimes some employees might leave and you might put a non-compete clause. Now that non-compete, one can say, is for 3 years, but the employee is not giving you any service for 3 years, and as a result we say that that has no connection with any service given to you, so you can't show it as your EB. And as a result, in certain cases, okay, again it depends on facts, it's a special case where you can even take this non-compete fees to the P&L as and when your non-compete agreement is entered and is effective. Okay, keeping that aside, if you do the accounting for non-market linked performance conditions, like for example, you are told that your vesting can happen if you achieve a certain earnings growth. If you achieve that in the first year, vesting will happen in the first year. If you achieve it in the second year, then in the second year. If you achieve it in the third year, then in the third year. And if you don't achieve it over 3 years, then the vesting will not happen. So merely because you stick around in the company for 3 years does not mean the options will vest. In such a case, what will you have to do? Well, in such a case, you will have to first figure out at each balance sheet date 3 things. First, did actual vesting happen during the year? So let us say the market price growth or not the market price, let's say the earnings growth. It's non-market linked. The earnings growth required was 20%. You grew in the first year only by 15%. So actual vesting will not happen in the first year. Okay. However, is it possible that the vesting may happen? Well, you believe that you will continue to grow at 15% for the remaining years, and the targets are that if the growth is 20%, the vesting will happen in the first year. If it is an average 12%, the growth vesting will happen in the second year. Average 10% vesting will happen in the third year, let us say. In which case, you will say that, well, you know what, the vesting did not happen in the first year, but if I continue to grow at 15%, the vesting is likely to happen, let us say, in the second year. So my estimated vesting period will be 2 years, and the vesting is likely to happen. However, it is also possible in the second year you did not grow at 15%, you grew only, for example, at 10%, in which case actual vesting may not happen in the second year. Again, you have to figure out whether it will vest or it will not vest, and if it does vest, when will it vest? Let us say in the third year. So you will have to, at each balance sheet date, figure out whether actual vesting has happened. If not, then is it likely that the vesting will happen? And if it is likely, then when will the vesting happen? So these are the 3 things that has to be reassessed at each balance sheet date based on the conditions prevailing at each balance sheet date. So it is fairly logical. We will do a sum on that as well, and accordingly you will do the workings. But when it comes to market linked performance conditions, ideally that same analogy should apply. So if it was not earnings growth and market price growth or a particular market price level, ideally you should have done the same thing. At each balance sheet date, you should have asked yourself that, has the actual vesting happened? If not, is it likely that the vesting would happen? If yes, when would it happen? And accordingly do the working. Accordingly estimate the vesting period and everything. Now the standard over here says that you should not be doing any of these for market linked performance condition. Now this is where you feel it to be a little illogical. The standard does not say it in so many words, but the rationale for this is, among other things, the rationale over here is, when you study AFM valuation, you will see binomial model, Black-Scholes model, etc. And in all of these models, when you do the option valuation, the input is the share price. So when you try to measure the shares as on, or options as on the grant date, you take the possibilities of different share prices being achieved over a stated period. and then you find the fair value. You don't look at sales, you don't look at earnings, you don't look at cost of production, but you look at the market price. So subsequently, if it is a non-market linked performance condition and let's say the sales estimate changes, that has no connection with the fair value, because fair value was not calculated based on the sales. But if the market price that you are expecting to achieve changes and you consider that estimate, then you are measuring the vesting period and a lot of things based on the market price position at the end of the first year. But when you look at the fair value, that fair value is determined based on your expectation of market price as on the grant date. And hence, in one set of workings, there would be inconsistent things that for the fair value purpose, you had taken the estimate of the market price or the vesting period that was based on the conditions as on the grant date. You said that because it is an ESOP, we cannot remeasure the fair value, and hence you stuck to the position, the estimates, the inputs used as on the grant date. However, if you can't remeasure the fair value because the market price has changed, you should not even change other factors which are linked to the market price. Otherwise, half of your working will be based on the market price estimate as at the end of the first year. Half of your workings like fair value will be based on the market price estimate at the grant date. Now, this will result in an inconsistent working, and hence this might be a little hard or difficult to swallow. But generally, the standard believes that if you cannot remeasure the fair value at each balance sheet date like an ESOP, then you can't even remeasure the estimates like the market price that have gone into the fair value determination. And hence, we will continue to show the workings for EB, SBP reserve, etc. based on the position as on the grant date. So as on the grant date, if you estimate the vesting period to be 4 years, then you spread it over 4 years. You will not remeasure it considering, no, now the vesting might happen in 2 years, now it might happen in 5 years. No, you will spread it over 4 years. The only exception to this rule is if actual vesting happens. Now, if actual vesting happens in a period shorter, so you estimated the vesting to happen in 4 years, actual vesting happened in 3 years. Now, earlier, on the grant date, if I expected the vesting period to be 4 years, I will do the EB working as 1/4, then 2/4. Ideally, then I should do in the third year as 3/4. But in the third year, if actual vesting has happened, I can't do 3/4 and then in the fourth year do 4/4, because for all you know, the shares are vested, employees have received. For all you know, employees might also leave the company. And hence, in the year of actual vesting, if it is shorter than the estimated vesting period, then whatever is the remaining EB will be recorded. So your EB will be recorded 1/4 in the first, 2/4 in the second, 3/3 in the third year. However, if the actual vesting is longer, you can do 1/4, 2/4, 3/4. Now, ideally, if it is longer than 4 years, you can do 4/5, 4/6, whatever it is. But that is again a change in your estimate, because I don't know when the actual vesting will actually happen. So if you can't change the estimates in year 1, 2 and 3, you can't change it in year 4 as well, and hence you will record 4/4. Further, in the 5th year, 6th year, whatever it is, there will be no further expense, but that is fine. Even when you look at PP items, you sometimes find that a PP has a physical life of 10 years, you depreciate it over 10 years, but you continue using it for the 11th year. There is no further depreciation in the 11th year. So long story short, if it is a non-market link performance condition, non-market link like earnings, sales, etc., then you will treat the vesting period, etc., considering the estimates at each balance sheet date. However, it is a market linked condition, then you will not go and reassess the possibility of vesting, what is the revised vesting period. No, you will not do that. You will take all of this based on the grant date only till the date of actual vesting. And on the date of actual vesting, if the actual vesting happens before, then whatever is the remaining EB will be recorded. If it happens after your estimated vesting period, then you will again spread it over the estimated vesting period only. No further changes. Probably will need some practice to get a hang of this concept properly. Okay, next is modification. Now we are almost at the last 3 special cases, I would say. Modification, then cancellation, and then graded vesting. So when you look at modification of exercise price, how will you do the workings for modification of exercise price? So basically, in case you had given an option to the employees, let us say whose exercise price was 50 rupees. Now, the vesting period was 3 years. The employees expected that after 3 years, for example, the price will be, let us say, 80 rupees. After 3 years, okay? And hence you use certain option valuation models and you found that on the grant date, let us say the fair value of the option is, let us say 30 rupees. Now you would be recording these options at 30 rupees over the 3-year vesting period. This is irrespective of the fact that how much will be your fair value at each balance sheet date. It does not matter. Maybe the fair value goes from 30 to 60, maybe it goes from 30 to 15 to 5 to 0. It does not really matter. You will kind of keep on recording. You do not remeasure the fair value of the ESOPs. So there would be no remeasurement. Yes. However, let us say after 1 year, let us hypothetically the company's performance is dipping and the market price is going down, and now the thing is, after 1 year, people do expect that the company will not probably have more than 55 rupees of price when the options vest, and hence the employees are not as motivated. So the directors take a conscious decision to, let us say, make the employees feel more valued, and hence they take a conscious additional step of reducing the exercise price. So let us say the exercise price, which was earlier 50 rupees, is now modified and reduced, let us say, to 35 rupees. Now, is that an additional action done by the management? The answer is yes. Now, because of that additional action, is there some benefit flowing to the employees? Well, in my books of accounts, I would have always recorded the options at 30 rupees. 30 rupees spread over 3 years. However, so let the fair value be 5, let the fair value be 50. It does not really matter later. So I will keep on recording these options at the fair value on the grant date and spread it pro rata. However, what if there is a change in the exercise price? Now the directors are consciously trying to take an action which results in additional employee welfare. But if I don't do anything, my workings will still continue as 30. So let us remeasure it. But you can't remeasure your options. Well, if there had been no change, still it will be at 30. If there's a change, it will still be at 30, because you can't remeasure your own equity. But then you can't even ignore it, because if you are ignoring it, you are telling the reader that, well, you know what, it does not really matter whether there's a change or there's no change. Now the directors are consciously doing something for employee welfare. So how does this get reflected in your books of accounts? The standard over here says that, okay, what are the possible options? One can say, let us remeasure. Remeasurement is not possible because you can't remeasure own equity. Then what will you do? The standard here says that let us treat it as if it is a new plan. What the modification results in something which is, let us say, a new plan. We can't understand how can it be a new plan. Let us say if we draw an analogy where hypothetically, let us say the company gave you for 3 years of working, let us hypothetically a bottle of Coke, a 500 ml bottle of Coke. Now, after 1 year, you want to do additional employee welfare. You want to motivate the employees. Probably you modify that and you say, instead of giving you a 500 ml bottle, I'll give you a 750 ml bottle. That is, you are agreeing to give an additional 250 ml. So rather than treating this modification as if it is a modified plan of 750 ml bottle, we say that the original plan of 500 ml bottles continue as it is. But additional over and above that, I am going to give you a 250 ml can. So how will I account for this? Well, the accounting for this would be, you will treat that 500 ml bottle as it is, and then for the 250 ml can that is given, you will spread the benefit of that additional action over the remaining 2 years on a straight line basis. Now, how will you quantify that? Now the management has taken an action. Because of that action, the fair value of the options which were in the employee's hands, which were worth 5 rupees, the fair value of those options are now, let us say, 20 rupees. Maybe 55 minus 35, that comes to 20 rupees. Maybe the fair value is 20 rupees. Now, if the fair value is, for example, 20 rupees, then because of the management's action, you are now holding a paper whose value is 20. Earlier, the value would have been 5. No, sir, in my books I am recording 30. Books mein kuch bhi hone do. The actual value of the paper in the employee's hands was 5 rupees. And hence, the management's actions increased the value of that paper to 20 rupees. And hence, 15 rupees, which is called as a incremental fair value, is nothing but considered to be the fair value of the so-called hypothetical new plan. Like, we want to find the fair value of the 250 ml can. We'll say that, well, on the date of modification, the 750 ml bottle is, let us say, quoting at 20 rupees. The 500 ml bottle is hypothetically quoting as 5 rupees. Then the additional 15, I know that's a little illogical, but the additional 15 rupees is the fair value of the 250 ml can. In a similar way, we are saying that had there been no modification, the fair value would have ideally continued to be rupees 5. Because of the modification, it becomes 20, and hence the additional is due to the action taken by the management which is beneficial to the employees and hence is resulting in additional employee welfare of 15 over and above the welfare that would have been recorded had there been no modification, that is 30 over 3 years. And as a result, we'll treat it as if it is a new plan. So your accounting would be, the 30 would be spread 10, 10, 10 over the 3 years originally. An additional plan hypothetically is assumed to be given at the end of the, or at the start of the second year, which is worth 15 rupees, and this 15 rupees will be spread over the remaining 2 years. So long story short, if there's a modification which is beneficial to the employee, now a reduction in excise price is usually beneficial to the employee. If there's a modification which is beneficial to the employee, you will record it as if it is an existing, you will record it as if it is an, let us say, an existing plan and a new plan being issued. The existing plan will be based on the fair value of the original grant date and will be spread over the original vesting period, that is 3 years, and the additional plan will be based on the incremental fair value as on the date of modification, which is calculated as the fair value immediately after modification, that is 20, minus the fair value immediately before the modification, that is 5. So 15 rupees is the incremental fair value, and that incremental fair value will be spread over the remaining vesting period, let us say that is 2 years. So that will quantify the total actions because of the management's original grant of 500 ml bottle plus a new 250 ml grant, and as a result, loosely speaking, that will give me the total employee welfare. Now, usually all institute questions that have come are usually based on the modification which is beneficial to the employees, where you will take the original plan plus a new plan at incremental fair value, but it is also possible that there is a modification which is adverse to the employee. Now, usually the modification which is adverse will increase the exercise price. So let us say in our original example where the price fell to 55, the market price expected, and the excise price was 50. Instead of reducing the excise price, management increased it. It took it to 52, 53, 55, whatever it is. In which case, the fair value after modification may be 2 rupees or maybe 0 rupees. Compared to fair value before modification, that is 5, and hence the incremental fair value technically comes to negative. Now, realistically speaking, if I keep the accounting aside, yes, that is an action which results in reduced employee welfare. However, in DAS 102, based on the strict legal form, they say, well, you know what, you cannot have a plan with a negative fair value. The fair value is 0. But sir, how can the fair value be 0? The standard assumes that again you treat it as if the original plan is continuing, and then there is a new plan, but this is a new plan with the incremental fair value which is a 0 fair value. Like for example, if the company's current market price is 50 and it is expected to go up to 50, 80, 100, you give a plan with an excise price of 5,000 rupees. That plan is like a piece of paper. I mean, people know that over 3 years the price will not touch to 5,000 rupees in general, and as a result that piece of paper does not have a negative value, it has a 0 value. Similar to that, over here the standard assumes that we have given a piece of paper additionally which has a 0 value. Technically, we can show this as negative. In my opinion, you could have put aside the strict legal principles and even show it as negative, because students also argue that sir, there's an actual reduction of employee welfare, which I agree, but the standard does not recognize that. The bare text has even some illustrations where they mention that, I mean, it's not there in the study mat institute material, but in case there is still, the principles remain same, whether it is beneficial or adverse to the employee, you will continue the original plan as it is, and then for the incremental fair value, you will treat it as a new plan and spread it over the remaining vesting period. But if the change is adverse to the employee, the incremental fair value will be negative, that is, you will restrict it to a 0 value, because plans cannot have a negative value. New plans, at best, it will have 0 value for the employees, and as a result, 0 prorated over the remaining vesting period is 0. So over here, if it's a change which is adverse to the employee, you will only have the original plan which you will spread over the total vesting period. Okay, so this is regarding modification of exercise price. Then there is cancellation. Now, what is cancellation? Well, cancellation is treated as acceleration of vesting. Now, students think that cancellation means you will reverse the entire EB, which is wrong. Remember, cancellation and lapsing are different. In cancellation, there was a 3-year plan which after 1 or 2 years, the organization thinks I will not be able to honor the commitment, and hence they say, well, you know what, we cannot give you the shares. But does that mean that you will not have to pay any compensation? No, you will have to pay compensation. This is like a breach of contract. And on breach of contract, you will have to pay compensation. So if you are paying a compensation, how will you measure this compensation? Well, usually, instead of giving shares, I'm giving cash. To whom am I giving cash? To whoever is the employees at the time when the contract is cancelled. And hence, cancellation is treated as acceleration of vesting, that is shortening of vesting period. Earlier, the employees had to continue for 3 years to be entitled to the shares. Now, at the end of the second year, we are now saying that we cannot continue with this plan. Does not mean that the plan lapses. Otherwise, we will give ESOP and then just before vesting, we'll say now, no, we don't want to give anything. There will be compensation because this is breach of contract. And because this is a breach of contract, you'll have to pay compensation. So we are saying that, well, you know what? Whoever is continuing at the end of the second year will be entitled. So it is possible that there were 10 employees and we were expecting one employee to leave each year. So basically we said that the plan will vest with 7 employees at the end of the third year. But now at the end of the second year, we are saying that we are cancelling the plan, which means whoever are the employees at the end of the second year will get the cash compensation. Now I might be expecting one of the employees to further leave. I cannot say, no, I know that you are going to leave in the next year. I will have to give the compensation to whoever is the employees existing at the end of the second year, and that compensation will be paid in cash. So what will we do? We will spread over the EB, ideally over the original vesting period. So let us say in the first year, we did not know that there was going to be any cancellation. So we'll spread the EB 1/3. And then in the subsequent years, in the second year, if there's a cancellation, ideally we should have done 2/3. But now in the third year, the plan is not continuing. In fact, whoever is there at the end of the second year will get the benefits, and hence you will do 2/2. Less earlier recorded, and that will give you the expense to be recorded for the second year. So you will get balance in the SBP reserve. Now, usually SBP reserve is settled by issuing shares, but here you will have to pay cash compensation. That is, you are paying cash. Now it is settling like a liability, not exactly like a liability. So the standard over here says that one could have said SBP liability to bank directly, but the standard says sometimes you might have to pay excess compensation as compared to the fair value. Now, if it is an ESOP, you have to settle by shares, so you don't care what the fair value is. However, in case of a SAR, you actually look at the fair value when you are paying. But now, in your books of accounts, you must have done the working based on the fair value on the grant date only. But now you are paying in cash. Let's say the fair value on the date when the payment is made is 90 rupees, but you are paying a cash compensation of 95. The holders are saying that you are breaching contract, you need to pay some excess compensation, and hence you are paying 95. You are paying 5 more. If you are directly do SBP reserve account debit to bank, I will not show a separate loss on this cancellation. So the standard says, well, you know what, from the SBP reserve to the extent permissible and possible, jitna ledger mein balance hai, to the extent possible, SBP reserve account debit to bank will be based on the fair value, as on fair value of the options as on the date of payment. So maybe on the grant date, the fair value may be 130, 150, whatever. On the date of payment, the fair value is 90. But are you paying 90? No, you are paying 95. But still, from the SBP reserve, you will say SBP reserve account debit to bank, for example, 90 rupees. What about the additional 5? Well, additional 5 will be shown separately in the profit and loss account. This is shown as loss on cancellation. So your journal entry, if there was one option only, would be SBP reserve account debit. Let us say 90, loss on cancellation account debit 5, to bank 95. Acha, Institute solutions end over here. They just give two things. They say, okay, cancellation is like acceleration of vesting, shortening of vesting period, and in cancellation, the compensation that you are paying, you will compare that compensation with the fair value. To the extent of fair value adjusted from the SBP reserve, and excess will go to the PNL. However, there is a possibility that after these adjustments, there may still be some balance in the SBP reserve. The institute remains silent. Technically, it should be transferred from one component of equity to another, and hence you should be transferred from the SBP reserve to, let us say in this case, retained earnings. We prefer passing that adjustment, though you will not probably see that in the institute's solutions. It will kind of keep it open. But ideally, to give a logical closure, we will transfer it from one component to equity, let us say to another. So that is regarding cancellation. And then lastly, there is a concept of graded vesting. This came, I think, in the RTP of November or May 23. What is graded vesting? It is nothing but phase-wise vesting. So rather than giving 100 options to the employees and saying that you continue with us for 3 years, you want to hold back the employees, you phase-wise give the option. So you say that out of the 100 options, 20 options or 20% will vest in the first year. The remaining 30% will vest in the second year, and the last 50% will vest in the third year. So for the first type of options, that is 20 options, the vesting period is 1 year, the fair value will be based on the 1 year vesting, and the employees will be based on the number of employees expected to remain at the end of the first year. Separate plan, 30 options treated as a separate plan with vesting period of 2 years, fair value according to the 2-year vesting, and the prorating will be done 1/2 and 2/2 based on the number of employees expected to remain till the second year, and so is the case with the third option. So basically, in case of graded vesting, that one single plan is segregated into different plans, assuming there were 3 different plans, one for 20 options, then for 30 options, and then for 50 options. So this, I think, kind of gives you a good roundup, probably in an hour or so, in a nutshell, for the entire concepts of Ind AS 102. Now we'll go to the important questions that we have in this topic. So we'll do around 7 odd questions covering performance based vesting, cancellation, modification, SAR, cash, ESOP with cash alternatives, everything. So hang on, let us get started. So we'll go to question number 1. This is a question involving, let us say, SARs. So you can review this question. We have a separate detailed YouTube video also for this. But nevertheless, if you kind of discuss this, an entity follows a financial year as the calendar year, grants 1000 share appreciation rights to each of its 40 management employees as on 1st January 15, that is a grant date. The SARs provide employees with the right to receive at the end, when they are exercised, cash equivalent to the appreciation in the entity's share price since the grant date. This is just explaining to you what SAR means. Even if the sentence was not given, the answers would remain the same. All the rights vest on 31st December 2016, which means there's a 2-year vesting and can be exercised during 17 and 18. So there is a 2-year exercise. Management estimates at the grant date that the fair value of each SAR is 11. It's a SAR, so you take the fair value at each balance sheet date, and overall 10% of the employees will leave during the 2-year vesting period. So 10% would be 40 minus 10%, and hence you're expecting 36 employees to continue till the end of vesting. The fair values of SAR at each year end is given to you. So these are the fair values. Because it is a SAR, you will take the fair value at each balance sheet date. 10% of the employees left before the end of 2016. You expected 10% to leave, actually 10% left. So the number of employees continued will be 36, 40 minus 10%. On 31st December 2017, when the intrinsic value of each SAR was 10. Now, remember, your valuation of SAR is based on the fair value, but when the employee actually resigns, he looks at the intrinsic value for the purpose of settlement. So, on 31st December, let us say 2000 and on 31st December 2017, the intrinsic value, for example, so if I were to take the intrinsic value is 10 rupees. 6 employees exercise their options and the remaining 30 employees exercise the options at the end of 2018 when the intrinsic value of SAR was equal to the fair value of rupees 12. So this is rupees 12. How much expense and liabilities to be recognized at the end of each year? You are required to pass the journal entries. So what will you do? Remember, there is a 2-year vesting period, and if there is a 2-year vesting period, you will take the number of employees expected to remain. So if you do the SAR working, you will say that there are 36 employees expected to remain. To each employee you have probably given 1000, and the fair value will be based on the fair value at each balance sheet date. So this is 12. This is, for example, in the second case also this is 8. Accordingly, you will find a number. You will prorate it over 2 years, 1 by 2, 2 by 2, less earlier recorded, and you will get the answer. So if you go to see the working over here, it is the same working, and you will probably get EBE to be recorded at 2,16,000 and 72,000. The important thing over here is you are taking the fair value at each balance sheet date because it is a SAR question and not an ESOP question. Your journal entries in the first 2 years will be EB account debit to SBP liability. In the first year 2,16,000, in the second year 72,000. Based on that, at the end of the second year, if I were to find the SBP liability, it will be the total of these two, which is probably 2,88,000. Now this 2,88,000 can also be calculated as 36 employees to whom you have given 1000 options, and each option having a fair value of, let us say, 8 rupees. So if I take 36,000 into 8, that is 2,88,000 appearing in your SBP liability. Now what happens during the exercise period is, out of the 36 employees, 6 employees leave. But when they leave, the intrinsic value is 10. When you actually have to pay the employees, you will have to pay based on the intrinsic value. So for these employees, to bank, the payment will be 10. For one employee, one option, let us say the payment will be 10 rupees. So let us say to bank 10 rupees. But SBP liability will be debited by what is there in your ledger. Now you have not remeasured anything as of now, and hence in your ledger for each option, the ledger balance is 8 rupees. So your entry will be SBP liability account debit 8, to bank, let us say 10, and hence there will be a balancing figure of 2 rupees which will go as EBE, employee benefit expense. Now this is for one option. If I were to look at it for 6 employees having 1000 options each, that is 6,000, your entry will be, well, SBP liability account debit. So you will debit the SBP liability. If you go to say SBP liability account debit 6,000 into 8, what is there in your ledger, that is 48,000, and for these 6,000 options you are going to pay 10 rupees. So to bank 6,000 into rupees 10, so this is 60,000. The remaining 12,000 is also going extra to the employees only, and hence the balancing figure will go to the EB, which is going in the PNL. So now these 6 options are settled. In your SBP liability you had 2,88,000. Out of the 2,88,000 you have debited 48,000, and hence you are at 2,40,000. Now this is for 30 options, 30 employees having 1000 options and each option measured at 8. But at the end of the third year, for the unexpired options, you will have to remeasure, but this remeasurement has to happen based on the fair value, that is 13. So, but intrinsic value is 10. But intrinsic values you were to exercise today. These 30 employees are not exercising today. Probably they are going to exercise in the future, and when they exercise, probably the appreciation is likely to be higher, and hence the measurement happens at fair value, which is 13. And hence, if I were to do the working, this is, well, 30 employees, 1000 options into rupees 13, and hence this is probably 3,90,000. Now in your ledger, you were showing this as 2,40,000, which is now going to be 3,90,000, and hence there is a 1,50,000 additional SBP liability. So you'll credit the SBP liability. What will you debit? Again EB in the profit and loss account. Well, why EB? Because this additional payment, if actually happens, will also go to the employees, and hence EB account debit. Let us say to SBP liability at 1,50,000, and hence your total amount that goes in the EB is 1,50,000 plus 12,000, that is 1,62,000 will go to the PNL. Now with this, in your SBP liability, you have 3,90,000, that is 30 employees, 1000 options into rupees 13. In the next year, if you go to see, all the 30 employees exercise, so SBP liability is debited, but it will be debited by what is there in your ledger, that is 3,90,000 to bank. But when they actually pay, the actual amount is 12 rupees, so to bank is 12. So that is 30 employees into 1000 into 12, so that is 3,60,000. But then there is still a balance. Well, that 30,000 is credited. It is like EB to be shown as a reversal, 3,90,000 SBP liability to bank 3,60,000, and 30,000 is EB reversal, which will be taken to the PNL, probably in the EB working like salary, wages. Here you will show a negative number, that is a reversal of your employee cost. So this is a brief discussion of question number 1. It's an interesting one. Second question is a question where students do have a doubt. This is a question with SAR and immediate vesting. So if you read the question, it says XYZ issued 10,000 SARs that vest immediately. The most important language over here is that vest immediately. And hence if they vest immediately, whether it is a SAR or it is an ESOP, the entire expense has to be recorded in the PNL immediately. Okay. To its employees on 1st April 2010. So on 1st April 2010, because it is immediate vesting, not because it is a SAR. Even if this was an ESOP, your working would have been same. Because it vests immediately, you will record the expense in the PNL. The SARs will be settled in cash using an option pricing model. At that date, it is estimated that the fair value of the SAR is 95. So basically, there are 10,000 SARs given to employees, and for each SAR, the fair value is 95, and hence 9,50,000 would be recorded in the PNL on 1st of April 2010. Your entry will be EB account debit to SBP liability. Let us say 9,50,000 entirely, no prorating required because of immediate vesting, not because it is a SAR, because it is immediately vested. SARs can be exercised at any time up to 31st March 2013. So there's a 3-year exercise period. At the end of the first year, it is expected that 95% of the employees will exercise the option. So that is 95% expected. In the second year, 92% of the employees will exercise the option. It is expected none of them have exercised. And at the end of the next year, 89% were exercised. Now, in general, if nothing was given, we will assume that if 10,000 options were there, 10,000 options would be exercised. However, the question specifically tells you that we believe only 95% will be exercised. Now, a student always argues that why will only 95% be exercised? Well, that depends on the facts. Like sometimes you might get customer loyalty points or rewards. Ideally, you should exercise them, but sometimes if there's a validity of 2 or 3 years, you might tend to forget it. So the measurement of liability should be based on the best estimate, of the liability. And the best estimate is, yes, you had 10,000 options, but only 9,500 of that are expected to be exercised. But if they are exercised, the fair value that you will have to pay is probably 112, because it is a SAR. Now, because it is a SAR, you are remeasuring. If this was an ESOP, you would not have remeasured, and you would not have taken the fair value. But here, because it is a SAR, you will remeasure, and hence 10,000 into 95% into 112. So that is probably 10,64,000 should be there in your SBP liability. But you already have 9,50,000, and hence you will pass an additional entry for 1,14,000 additionally. So EB account debit to SBP liability for that 1,14,000. So this is 1,14,000. So the first entry will be on 1st April 10 for 9,50,000. Second entry on 31st March 11 for 1,14,000. Now going forward, you are further expecting no one has exercised, but you now believe only 92% of the employees will exercise. And if only 92% exercise, that is 10,000 into 92%, that is 9,200 into 109. And hence your liability will probably be 10,02,800. But you have already recorded this at 10,64,000. And hence 61,200 will be a reduction. So be it. You have to measure the fair value, which is the most reliable value. So that is 61,200 reduction. that is SBP liability account debit to EB, basically reversal. If you go to see, that is 61,200 over here. And then when you actually go at the last year, there are two ways in which you can solve. Both of them will ultimately give you the same answer. Either you directly pay like you did in question number 1. You said, okay, in my SBP liability, I have 10 lakh 2,800. Ultimately, now at the end on 31st March 13, I know that to bank ultimately how much is getting paid. Well, 10,000 into 89%. So exercise is happening for 8,900 options into, at that point 114 is the payment. So this is 8,900 into 114. I'm actually paying 10 lakh 14,600, and hence the remaining 10 lakh 2,800, and the difference of 11,800 will be going as EBE in the profit and loss account. Go as EB in the profit and loss account. Alternatively, you can remeasure the liability from 10 lakh 2 to 10 lakh 14. Take 11,800 in the EBE, and then your liability is 10 lakh 14. Discharge that liability. So over here, you can either remeasure like you have done that over here, EB to SBP liability, and then SBP liability account debit to bank. So over here we have not, I think, shown that final payment entry, but otherwise there will be SBP liability account debit to bank. Also over here, this is an SBP liability account debit to bank entry at 10 lakh 14,000. Or you can directly show this payment entry either ways. The common doubt over here is always that why are we not spreading this over 3 years? It is because it is an immediate vesting case, and hence you do not spread it over 3 years. Okay, next is question number 3, which is on group share based payment. So over here the parent is granting 200 share options to each of the 100 employees of its subsidiary. So group share based payment, conditional upon the completion of 2 years service with the subsidiary. So there's a 2-year vesting. The fair value of the share options, it's share options not SARs, on the grant date is 30. Because it is share options, you will not remeasure it, so you will take 30 as on the grant date only. At the grant date, the subsidiary estimates that 80% of the employees will complete the 2-year vesting period. So basically 100 into 80%, that is 80 employees are likely to continue till the end of the vesting period. The estimate does not change during the vesting period. Perfect. So throughout the 2-year vesting period, we expect that 80 employees will continue till the end of vesting. But when you actually reach the end of the second year, you take a HR head count, and at the end of vesting period, you actually see 81 employees are completed the vesting period. You estimated 80 will complete, but actually you see 81 have completed. So over here, when you do the working year 1, year 2, you say that, well, at the end of year 1, you expected 80 employees to continue. However, actually 81 completed, so your cost will be based on 81 employees. For each employee, you are giving 200 options, and the fair value as on the grant date is going to be 30. So over here, this is 80 into 200 into 30. Probably this is 4,80,000. Now this 4,80,000 is going to be spread pro rata 1 by 2. That is 2,40,000 in the first year, and then probably 81 into 200 into 30, that is equal to 486. 486 into 2 by 2, that is entire 486 should be recorded minus 2,40,000 earlier recorded, and hence the difference, I think 246 will be recorded in the second year. So this is 240 and 246 you will measure. You can either prepare a table or you can even do a horizontal direct working, whatever is comfortable. Okay. The parent does not require the subsidiary to pay for the shares needed to settle the grant of the share options. Even if this sentence is not given, you generally assume that the parent does not require the subsidiary to pay. And as a result, when the parent is giving this in the first year, what will be the entry in the books of the parent? Pass the journal entries for giving effect to the arrangement in the books of subsidiary. You can even pass it in the books of the parent. So in the books of the subsidiary, is employee welfare happening? Answer is yes. So EB will be debited. At how much? Well, in the first year 2,40,000, in the second year 2,46,000. But can I credit the SBP reserve? No. Can I credit the parent? No. Acha, had the parent required, yeah, but it is given does not require, but had the parent required compensation, then you would have credited, let us say, the parent. So the money is payable to the parent. Here that is not the case. So what will you credit? Well, we will credit the capital contribution. So basically your journal entry is EB account debit to capital contribution from the parent, and capital contribution will appear in other equity. If you had to pass entries in the books of the parent, well, in the parent there will be SBP reserve, to SBP reserve, 2,40,000, 2,46,000, but what will you debit? Investment in subsidiary. So over here, if you were to see the entries, EB account debit to capital contribution from the parent, and that is about it. In the parent's books, investment account debit to SBP reserve over the 2 years, same at 240 and 2,46,000 will be your effects. If there was a reimbursement required, then there would not be capital contribution or investment. In fact, you will credit the parent in the books of the subsidiary because you have to pay. In the books of the parent, you will show a receivable from the subsidiary in case that is the case. There's one more sum that you do in the study material where you have agreed that 75% of the expenses will be reimbursed and 25% will not be. In which case for 75% you will book a receivable / payable, and for the remaining 25% there will be an investment / capital contribution. So that is an extra additional adjustment. Okay, next you go to question number 4. Now on 1st January 11, this is like ESOP with cash alternatives. On 1st January 11, ABC Limited gives options to its key management employees to take either cash equivalent to 1000 shares or actual 1500 shares. Okay, so this is ESOP with a cash alternative. Either you take 1500 shares or you will get a cash equivalent to, let us say, 1000 shares. The minimum service requirement is 2 years and the shares must be kept for 3 years. Remember, the vesting period is 2 years only. After 2 years, you may not be able to sell the shares, but you can leave the company if you want to. So you will spread over the vesting period, that is 2 years. The key management exercises the cash option at the end of 2012, but that you will know at the end of 2012, not before that. Pass the necessary journal entries. The share alternative fair value with restrictions is 102. This is on the grant date, and the grant date fair value on 1st January 11, then 31st December 11 and 12. This will usually be for shares which are freely tradable. So now you will treat this question as if it is a pure SAR but with an equity option. So now SAR is going to be measured based on the fair value at each balance sheet date which you have, but you want to measure the equity option. So how will you measure the equity option? Well, on the grant date, that is 1st of January 2011, you will say that if all employees, here there is only one employee, were to exercise. So we do the working on a per employee basis, were to exercise equity option, they will get 1500 shares, and each share on the grant date, let us say the fair valuation based on the expected prices, let us say maybe 68, and hence this comes to probably 1,02,000. This is 1500 into 68, 1,02,000. If they were to take the cash option, in which case this is going to be 1000 into 70, and as a result this is, just a second, 50, no, this is not 68, 68 was there in our example, this is 102 and this is 113, so this is basically 1,53,000 and this is 1,13,000. Now, like in a convertible debenture, what do? You take the total issue proceeds, liability component, and the balancing figure is equity component. Similar to that, you will say how much will be the equity component. We will say that, well, 1,53,000 will be the total value, out of which 1,13,000 is attributable to the pure SAR, and hence the remaining 40,000 is treated as the value of the equity option. Now in each year, what will you do? You will try to find the EBE as if it is a pure ESOP. So basically, as a pure ESOP, let us say there is one employee and that one employee has 1000 options, not 1500. 1500 is if it is in shares, and these 1000 options will be based on the fair value at each balance sheet date. So this is basically 120 and 132. So this is 120, 1 into 1000 into 132, and as a result, if you go to see, this is what, I think 1,20,000 prorated 1 by 2. So this is probably 60,000 less earlier recorded. In the second year, 1,32,000 minus 60, that is I think 72,000. So this will be pure SAR. But apart from that, you are also giving an additional option. That option is worth 40,000, and that is also if you serve for 2 years, and hence 40,000 into 1 by 2 and then into 2 by 2, and hence 20,000 will be recorded in each year. So what will be your journal entry? Well, if you go to see 60 and 72, 20 and 20, your journal entry will be EB account debit. Well, 60,000 plus 20,000, that is 80,000. To SBP liability 60, to SBP reserve 20. So over here, this is EB 80. In a similar way, if you want, you can try to do the working for the second year. EB account debit, how much will that be? Well, it will be 72 plus 20, that is 92. To SBP reserve 20, to SBP liability 72, and with that, at the end of the second year, SBP liability will come to 1,32,000. Your SBP reserve will come to, for example, 40,000. Now the question very clearly tells you that the employee exercises the cash option. If they exercise the cash option, your entry will be SBP liability account debit to bank. Acha, you are paying that immediately, and hence there is no difference between fair value and intrinsic value. At least the data is not given, so you will have to assume that the payment happens at the same amount. So this is SBP liability account debit to bank. Acha, how much is the balance in your SBP liability? Well, it is 1,32,000 to bank 1,32,000. Perfect. But what about the balance in the SBP reserve? Transfer from one component of equity to another. It is like lapsing, and hence it will be transferred to retained earnings. SBP reserve account debit to to retained earnings. Now, question has not told you, but if we were given that equity option is exercised, then as per ICI solution, there are two possible ways. You can say SBP liability account debit 1,32,000, SBP reserve account debit 40 to equity share capital, let us say / securities premium. So this is for 1500 shares into whatever is the face value, the balancing figure is securities premium. Otherwise, you say to share capital / securities premium. Alternatively, you can say SBP liability account debit 1,32,000 to share capital / securities premium 1,32,000, and for the remaining balance in the SBP reserve, transfer it to retained earnings. Both of these are components of equities. So over here, this is transferred to retained earnings or alternatively transferred to securities premium. Fundamentally, I believe the second method is much more logical to adjust it as a part of a single entry. Okay, next you go to ESOPs with a vesting period where there is performance linked vesting. So if you look at question number 5, at the beginning of year 1, enterprise grants 100 stock options to each of its 500 employees. So there are 100 options to 500 employees, condition upon the employees remaining in employment of the enterprise during the vesting period. So there is a service condition, they have to remain in employment. The options would vest at the end of year 1 if the earnings increase by 18%. At the end of year 2, if they increase by an average of 13% over the 2-year period. At the end of year 3, if they increase by an average of 10% over the 3-year period. Okay, so there is some performance condition attached, but that performance condition is linked to earnings growth or average earnings growth, which is not linked to market price, and hence we can say that this is a non-market linked but performance condition, non-market linked performance condition. Okay, in which case you will try to at each balance sheet date estimate whether actual vesting is happening or not, whether vesting will eventually happen or not, and if it does happen, when will it happen. Okay, the fair value of these options is 30 per option. Okay, so all of this is the position as on the grant date. Now at the end of the first year, the earnings actually increased by 14%. Now will the actual vesting happen? If I go to see actual vesting, does it happen in year 1? Answer is no. Well, why? Because the question gives you that if you read further. However, the growth rate should have been 18% for vesting to happen in the first year, so it does not happen because the growth is only 14% and 30 employees left. Okay, so now 500 minus 30, you have 470 employees. The entity expects the earnings will continue to increase at the same rate in the second year. So 14% in the first year, 14% in the second year, average growth of 14%, which is greater than 13% target of the second year. So will the vesting happen? Yes. When will it happen? Well, probably in the second year. So is there a possibility of vesting? Possible vesting? Yes. When will the vesting happen? Well, in year 2. Okay, the question tells you that, and the option would vest at the end of year 2. The enterprise expects a further 30 employees would leave during the second year, and hence when the vesting happens, you will have probably 500 minus 30 actually left in the first year, minus 30 expected to leave, and hence probably you will have 440 employees, and therefore expects that 440 options will vest at the end of the second year. Perfect. At the end of year 2, earnings have actually increased only by 10%. So actually, if you go to see 14 plus 10 divided by 2, average growth is 12%. And hence, if I go to year 2, I expected vesting to happen, but it did not happen because the average growth was not more than 13%. So there is no vesting. But does that mean they lapse? No. And hence, options do not vest at the end of year 2. 28 employees have left during the year. We expected 30 to leave, 28 left. That's fine. And the enterprise expects another 25 will leave during year 3. And the earnings for the enterprise will increase by at least 6%, thereby achieving the average growth of 10%. So if the average growth of 10% is achieved, will the vesting be possible? Yes, but when will it happen? Well, at the third year. So we will have to find the number of employees who are expected to remain till the end of third year, which is 500 minus 30 actually left in the first year, minus 28 left in the second year, and another 25 expected to leave in the last year. So this is 470 minus 28 minus 25, so probably 417 employees. And last year, 23 employees have actually left. And the earnings of the have increased by 8%, resulting in average increase of 10.67%. So in the third year, has the actual vesting happened? Yes. So 419 employees received 100 shares at the end of the third year. Now the question arises that should we look at the estimated vesting period and the possibility of vesting at each balance sheet date? Answer is yes, because it is a non-market linked performance condition. If this was a market linked performance condition, you would have done the working based on the position as on the grant date only. So over here, if you were to go to see, in the first year, you will start with 440 employees which are expected to remain for the 2-year vesting. into 100 options per employee into 30, which is the fair value, and then prorate it over 2 years, because you're expecting the vesting period to be 2 years. But when you go to the second year, you see actual vesting does not happen in the second year, but you do expect vesting to happen in the third year, and hence you will now take the number of employees expected to remain till the third year, that is 417 employees, and then everything else remaining constant, you prorate it over 2 by 3 years. Your estimate of the vesting period changes 2 by 3 years, and then in the last year you actually see 419 employees continuing and the vesting actually happening, and hence you will take 3 by 3, and hence your expenses will be recorded accordingly. One needs to remember that if this was non-market linked performance condition, you will not do this 1 by 2, 2 by 3, etc. You would have had an estimate of the possibility of vesting and the estimated vesting period based on which the fair value was determined, and you will prorate it over that period only in general. Okay. Then you go to question number 6, which is on modification. Now QA Limited had on 1st April 11 granted 1000 share options to each of its 2000 employees. Okay, so this is on modification, 1000 share options to each of its 2000 employees. The options are due to vest on 31st March 2014. So that seems to be a vesting period of 3 years. Provided the employees remaining in employment till 31st March 14. So that's fine. That's a service condition. On 1st April 11, that is a grant date, the directors estimated that 1800 employees would qualify for the option on 31st March 14. This is an estimate on the grant date. The estimate was amended to 1850 employees on 31st March 12 and further amended to 1840 employees on 31st March 13. So if you go to see as a summary, on 1st April 11, your employees expected to continue till vesting was 1800. By the end of the year, you do the accounting at the end of the year, the estimate changed to 1850, and then by 31st March 13, it changed to 1840. Now on 31st March 14, on the date of actual vesting, you have not been given how many employees actually continued. Fair enough. Achha, on 1st April 11, the fair value of the option was 1.2 and the fair value increased to 1.3 as on 31st March 12. Okay, so you have been given the fair values on 1.2 and it increased to 1.3. Now, you are usually saying that, okay, fair value is given, you will take the fair value as on each balance sheet date. Answer is no. If it is a SAR, you take the fair value at each balance sheet date, but if it is an ESOP, you take the fair values on the grant date only. Over here, it is share options to receive shares and not share appreciation rights, and hence you will take the fair values on the grant date and grant date only. So everything else over here is not relevant for the purpose of calculating the ESOP expense. You will take 1.2. But due to challenging business environment, the fair value declined thereafter. In September 12, the fair value of the option was 0.9. So over here, if you go further, let us say somewhere in the middle, you also have a 30th September 12, when the fair value declined to 0.9. So be it, we do not remeasure to 1.3, we will not even remeasure to 0.9. But here what is happening? And the directors reprice the option and cause the fair value to increase to 1.05. So over here, possibly, there is a modification happening. And the fair value of the modified plan at this date is 1.05. So basically, because of the modification, is the fair value increasing? Yes. How much is it increasing? Well, it is increasing. You guys think and tell me. Well, it is increasing by 0.15. So over here, you will have something called as an incremental fair value, which you calculate on 30th September 2012, which is basically 1.05 minus 0.9, and hence this is 0.15. Now this is incremental fair value. Remember, your original plan is still at 1.2. It did not come up to 1.3, it did not go down to 0.9. That continues at 1.2. However, you did an additional action which increased the value by 0.15. So that is additional employee welfare arising from 30th September 2012. Trading conditions have subsequently improved in the second half of the year, and the fair value of the option was now 1.25. Now that does not really matter. The value may go up to 1.25, but all of these don't really matter. Okay, because you will continue at the fair value on the grant date. For the first plan, the grant date is 1st April 2011. At that date, the fair value was 1.2. For the second new plan, the grant date is 30th September, in which case the fair value is, for example, 0.15. Okay. QA decided that the additional cost incurred due to repricing of the options on 30th September should be spread over the remaining vesting period. What is the remaining vesting period? 18 months. Usually, you're usually trained to think that the vesting period is for the remaining, let us say, full years, but that is not necessary. You can always have a 1.5 year, 1.5 years or 18 months remaining vesting from 30th September to 31st March. Okay, so that is a 1.5 years or an 18-month vesting, out of which 0.5 years or 6 months are arising during the year 12-13 and the remaining 12 months or 1 year is arising during the year 13-14. The company has requested you to suggest accounting treatment for these transactions as on 31st March 13, not for the year 11-12, not for the year 13-14. So that is why the data for 13-14 is not given, how many employees actually remained, etc., and hence 13-14 data is not given. So we'll say let us do only for 12-13. Here we will also have to do 11-12 because the expense for the year 12-13 is the EB till date less EB earlier recorded. So over here we will say that for the year 11-12, based on the latest estimates, we expect 1850 employees to continue. And as a result, if I were to do the working, I would say the number of employees, when I do the year 1 working, the number of employees expected to remain is 1850. Now these employees are going to get how many options? Well, they are going to get 1000 options, and the fair value of each of these options is, let us say, 1.2 as on the grant date, and hence this is 1850 into 1000 into, for example, 1.2, which will come to, let's say, 22 lakh 20,000. Now this 22 lakh 20,000 you will spread pro rata 1 by 3 divided by 3, and hence I think less earlier recorded is nil, and hence 7 lakh 40 will be recorded in the first year. There was no new plan. However, in the second year, when you go to the second year, we will still continue to record. Well, this is 1840 into 1000. This will still be 1.2. No sir, the fair value is 1.3, 1.25, does not matter. You will still continue to record the original plan. For the new plan, you will have an incremental fair value into 2 by 3 less what is earlier recorded is 7 lakh 40. So if I do the working over here, 1840 into 1000 into 1.2 into 2 by 3. So this comes to 14 lakh 72 minus 7 lakh 40, and hence this is 7 lakh 32,000, which is going to be recorded in the second year. So this is on the original plan, but there's a modification where the incremental fair value is beneficial. So over here, this was the year 12-13. Again in the year 11-12, there was no new plan, but in the year 12-13, there was a new plan which is due to 1840 employees into 1000 into the incremental fair value, which is 0.15, and hence we will say 1840 into 1000 into 0.15, that is 2 lakh 76. But this 2 lakh 76 will be prorated how much? Well, this will be over 6 months during the year over the 18-month vesting period, or 0.5 years over the 1.5 year vesting period, minus nothing is recorded earlier, and hence into 6 by 18. If I go to see, this is 92,000. And because of that, if someone asks me that what is the expense to be recorded for the year 12-13, it is 92 plus 732, and hence 8 lakh 24 of total expense. So this is 732 and 92 will be recorded in the year 12-13. Okay, so this is regarding question number 6, and then you have another question which is on cancellation. Now, Anara Fertilizers has issued 2000 share options to each of its 10 directors. If you see the study material language, they just mentioned 2000 share options to its 10 directors. So a similar sum had come in the exam where they had given 2 alternative solutions. You can assume 2000 to each of the directors or 2000 per director. Institute's study material solution is 2000 for each of the directors, so we have just kept that constant set. Let us assume this is 2000 to each of the directors. For an exercise price of 100, the directors are required to stay in the company for the next 3 years. So the vesting period is 3 years. The fair value of the option is estimated at 130 on the grant date. Expected directors to vest the option is 8. So you're expecting 2 of them to leave over the 3-year period. But during year 2, there was a crisis in the company and management decided to cancel the scheme immediately. And it is estimated further as follows: the fair value of the option at the time of cancellation was 90. Now you might also be given the fair value of the shares. Remember, what you are giving to the employees is the option, and hence the relevant value for you is the fair value of the option. There was a compensation which was paid to the directors, and since 9 directors were currently in employment, now you might be expecting that over 3 years there will be only 8 directors, but you are cancelling the plan at the end of the second year, and at that time there were 9 employees. Now during the date of cancellation, such scheme and hence 95 per option has been paid to each of the 9 directors. How will the cancellation be recorded? Now 3 relevant parameters over here. First is cancellation is treated as acceleration of vesting. So if I go to year 1, I expected 8 directors to remain. Each of these directors have 2000 options, let us say, and the fair value is 130, and hence this is what, 8 into 2000 into 130, and this comes to, let us say, 20 lakh 80,000. Out of this 20 lakh 80,000, 1 by 3, because in the first year we did not know that there was any cancellation, 6 lakh 93,000, 333 would be recorded. So this is 6 lakh 93, 333. Now when you go to the second year, there's an actual cancellation, and hence you will take the number of employees to whom the plan vests, that is 9, into 2000 into, again it's an ESOP, acceleration of vesting, and hence this will be treated as 9 into 2000 into 130. You will not remeasure anything. This is 23 lakh 40, entirely prorated 2 by 2, and hence 23 lakh 40 to be recorded less whatever is earlier recorded, 6 lakh 93 333, and hence the remaining, what do you say, 693 333. So the remaining 16 lakh 46,667 will be recorded. So 693 333 and 1646 will be recorded, and therefore your SBP reserve will be appearing at 23 lakh 40. Now this 23 lakh 40 for your reference is nothing but 9 employees into 2000 into rupees 130. But how much are you actually paying? Well, you are actually paying a cash compensation of 95. So to 9 employees into 2000 into 95. So your total cash compensation is probably 18,000 into 95, which comes to 17 lakh 10. But that is a payment. Out of that, how much will be adjusted against the SBP reserve? So against the SBP reserve, to the extent of the fair value, that is 9 into 2000 into 90. And as a result, this is 18,000 into 90, which is 16 lakh 20. And hence the additional, if any, will be shown as loss, which will be taken to the P&L account. So this is another 90,000, I believe. And as a result, over here, we will pass the entry. If you had to pass the entry, SBP reserve account debit 16 lakh 20. So you will have, let us say, SBP reserve account debit 16 lakh 20 to bank 17 lakh 10. And as a result, the balancing figure of 90,000 will be the loss. Now with that, your balance in the SBP reserve comes to, let us say, 23 lakh 40 minus 16 lakh 20, which is adjusted, and hence there is another, I believe, 7 lakh 20,000 balance which is still lying. Can it continue to remain in SBP reserve? My sense is no, and hence an additional entry of transferring this to the retained earnings is an appropriate entry that we have additionally passed, though institute, if you see, has not passed a separate entry for the same. So that kind of, I believe, takes care of share-based payments, concepts, and the important sums. Hopefully you have got a better perspective and clarity and a quick revision for this entire chapter, including the important questions. If you do like it, please like the video and share your comments on what else do you think would help more, and we would be happy to kind of try to give more videos that help you. So that should be it. Thank you very much. I'll see you soon with another video. Till then, bye bye, take care and study well. And yes, please do subscribe and hit the bell icon. Means a lot for us, and you will get constant updates. See you. Bye bye, take care.